Welcome to this session where we are talking about the 2021 ASEAN Markets Outlook. We have all the respective heads of research from all 6 countries in ASEAN, and we will be running through a presentation where we will be talking about the outlook for the respective countries. So without further ado, I'll just hand you over to Dan, who will talk about the overall outlook for ASEAN and then take you through Thailand, and then we'll move along in that order and finish off with Q&A. Over to you, Dan.
Wonderful, thanks, Danny. So let's open to the slide deck. We have a positive outlook for ASEAN in 2021. We're expecting a much better year for the region than we had last year. Let's advance to the first slide. Go right. So let's first look at last year, which was really a horrendous year for ASEAN as far as relative performance is concerned. If we start with the macro picture, you can see that ASEAN economies were hit much harder by the pandemic than most of the rest of the region. Only India saw a greater change in GDP growth than the ASEAN countries in 2020. This was because the ASEAN countries were exposed either externally, as was the case for Thailand, Singapore, and Malaysia, via high exports and high tourism exposure, or in the case of Philippines and Indonesia, those 2 countries had the worst domestic outbreaks. Next slide, please. The negative GDP outcome had an unsurprising impact on EPS. EPS in the region contracted more than for the rest of Asia. 3 of the worst EPS outcomes were in ASEAN. 5 of the 7 worst were ASEAN. Next slide, please. The negative EPS outcome in turn had an impact on market performance. The 5 worst performing markets in Asia Pacific last year were the 5 ASEAN markets. But next year we're expecting a much better outcome for 3 reasons. Next slide, please. The first factor is the principle that the harder they're hit, the bigger they bounce. And we're expecting, and the Street and Credit Suisse are expecting that the EPS growth for ASEAN will be better than for the rest of the region this year on the bounce back principle. 2 of the best EPS growth finishers this year are 2 ASEAN countries, and again, 5 of the top 7 are ASEAN countries. Next slide, please. The second factor favoring ASEAN this year is the global rates and liquidity environment. Typically, ASEAN outperforms when global rates are low and steady, as was the case from 2001 to 2004 and from 2010 to 2013. Right now, rates are low and steady, and they'll probably stay there for at least 2 years, maybe even longer. Next slide, please. The third factor favoring ASEAN this year is valuations. Because of the weak performance last year, valuations are now quite attractive for all the markets in the region. On our Asia Pacific markets valuation scorecard, the top 5 of the top 6 countries are from ASEAN, and the top 2 are ASEAN countries. So these 3 factors lead us to believe that ASEAN is going to be doing much better this year than last year. Next slide, please. Okay. And we also think that there are structural factors that the market has forgotten about. Right now, investors are focused on ASEAN's structural weaknesses, which are basically a lack of tech exposure. But if you go back to the previous 15 years, through much of that period up until about 2013, people viewed ASEAN as a growth region. Why? Number one, demographics, very fast population growth, by global and regional standards. Next slide, please. Also young populations. And then if we go to the next slide, please, there's also low penetration credit, which means for countries that have low penetration, there's a good outlook for loan growth. And there's also low penetration for a number of consumer industries like e-commerce. So there are cyclical tailwinds this year that favor ASEAN and some structural factors that I think are overlooked that investors will start to appreciate again as the cyclical factors come to the fore. Now, one caveat is that it's going to be largely a second half story for most of the markets in the region. Singapore, I think, can be a good first half story because it's going to get vaccinated fairly early. It has a small population with a big pharmaceutical industry, but the rest of the region isn't going to be fully vaccinated until the end of this year or maybe next year. And that means that first half of the year is going to be dull with people with a lack of catalysts, and it'll only be in the second half of the year as people start to anticipate a reopening of economies that the rest of ASEAN will start to move. What are our favorites? Well, for the first half of the year, I'd favor Singapore. For the second half, number 1, Thailand, and number 2, Indonesia. And with that, let me move on to Thailand, which, as I noted, is our favorite market for the second half of the year. Next slide, please. And one more, please. Again, working on the harder they're hit, the bigger they bounce theory. Well, Thailand was at the absolute bottom of the pack for APAC last year as far as market performance is concerned. Next slide, please. And that's left the market quite cheap. Its cyclically adjusted PE is very low by historical standards. Next slide, please. And the market is cheap relative to APAC peers. Next slide, please. What is it that made Thailand hurt so much by the pandemic? Well, it's the tourism exposure. The domestic side has been, up until recently, quite controlled, but Thailand's tourism industry is the biggest in Asia relative to its economy, contributes 11.5% directly to GDP. If you add in second round impact from workers and businesses in the industry that are spending either on consumption or investment in tourism-related businesses, you're talking about 15 to 20% of GDP coming from international tourism. That's now completely gone. But when that reboots, most likely towards the end of this year or early next year, you're going to have a massive boost to GDP and EPS. Next slide, please. Another factor holding back Thailand this year has been EPS cuts. Thailand has had the worst cuts in the region. There's really two major drags there. Number one is energy, but that ought to be more stable and maybe even positive going forward. Our house view is that oil prices have bottomed and will rise moderately over the course of this year. Next slide, please. The other sector that's been problematic is banks, but there as well, we think that the cuts are largely behind us. If you go back to April, May, we were way below consensus for banks' earnings, but consensus has now come down to our level. So I think that the cuts are largely finished for the banks. Next slide, please. And there's a lot of dry powder that can push Thailand up when the catalysts come in the second half of the year. If you look at the slide on the left, you can see that there's been more foreign selling in Thailand than for any other market in the region over the past 3 years as a percent of market cap. And you can see in the chart on the right that foreign ownership of the market is just a little bit off the lowest we have on our records. So if Thailand becomes of interest again to foreign investors, which we think will happen in the second half, there's potentially a lot of money that can come into the market. Next slide, please. So what do you buy? Well, we've got some tourism in there. These stocks look cheap to us on a long-term, beyond the pandemic basis. AOT, Centel. We like healthcare on a structural basis. This is Thailand's best structural growth industry. So we've got BDMS, CHG. We've got some banks which are going to be a second half story. Those are going to be weak in the first half, but there our two favorites are BBL and K-Bank. And if you are interested in another structural growth story, Sawat in non-financials. And then in retail, which we consider a structural growth area as well, you've got CPL and CRC. And with that, I'd like to turn it over to the next speaker, please.
Hi, good afternoon, everyone. This is Gerald. I head up the Singapore Equity Research Team, and I'll go through the view on the Singapore market over the next few slides. For the Singapore market, what we really believe is that there is value, and especially if investors are looking at recovery and restructuring, then the Singapore market will be where the opportunities actually lie in. Maybe just continuing through from what Dan mentioned in terms of the harder the hit, the stronger the bounce. This is what we see as being the driver for the Sing market. Given the sharp fall in GDP growth of 6% in 2020, we believe that there is scope for the economic growth to be near 6% in 2021. The recovery will be driven by several factors, including the improvement in domestic mobility trends. It will be driven by the improvement in global GDP growth, as well as the rollout in vaccination. Our expectations are above the current market expectations, and that effectively is where we see the upside in the market coming through from. Next slide, please. So firstly, in terms of the control of the pandemic, this is where Singapore has done pretty well. If you look at the number of community cases in the country, we have effectively had very limited community cases since September this year. So this has really hastened the reopening of the economy. And if you look at some of the statistics like the mobility data, the workplace activity, we are now effectively back to within 15% of the pre-COVID levels. This will probably further improve as Singapore has entered the phase 3 reopening in December last year, which has really increased the amount of activity within the whole economy. Next slide, please. The other key driver, like Dan mentioned earlier, is really the vaccine rollout. We have had some of the initial vaccinations starting from late last year, and this is something that will be available to the entire population by the third quarter of this year. Given that Singapore is very externally driven, we really want to be reopening our borders, and with the population being vaccinated, this will potentially accelerate the pace of reopening. Next slide, please. The other point that I really want to highlight is that from a structural basis, we do not see any significant permanent damage, and that is really coming through from the very significant fiscal stimulus that the government had through the pandemic. If you look at the government spending as a percentage of GDP and the various support schemes that have really come through, it has helped to cushion the impact of COVID-19. And as the recovery globally takes place, we believe that that will be beneficial to Singapore as well. Next slide. So what does this actually translate to earnings and the market? Once again, in terms of the earnings recovery, we do see very strong improvement in the earnings momentum in Singapore for 2021. And this has already started to come through. If you look at the earnings revisions number, we had the first month of positive earnings revision in November, and given our view that the recovery will continue to take place, that would be positive for the earnings momentum trend going into 2021. Next slide, please. In terms of the sectors that is driving this earnings recovery, once again, it would be the sectors that have been hit the hardest, and that will be coming through mainly from the banks and transport sectors. I will also use this to explain why our top picks are within these sectors when we go through the stock recommendations later. Next slide. And I think really in terms of why we believe that this has not been priced in by the market, if you look at where current consensus expectations are, the market is still expecting that the earnings for 2021 will be about 10% below the 2019 levels, which we believe is too conservative given our expectation that the economy will be back to the pre-COVID levels by the end of this year. Next slide. The other key theme that we would really suggest for the Sing market is restructuring. This is something that has already been ongoing as a theme over the last few years, but with the structural shifts driven by the pandemic, it will likely continue to feature as an important share price driver. And it will probably be across several layers, including economic reform, industry transformation in the form of the role of the digital banks and 5G network. And last but not least, corporate action as companies look at different ways that they can undertake to be boosting their returns. Next slide. So what we really believe in terms of the Sing market is the value proposition. If you look at, say, PE, the market is now trading at a sharp discount to the region and the widest that it has ever been compared to the global financial crisis. Next slide. From a price to book perspective, this is attractive as well. If you look at it, it is trading at 1.1 times price to book, really not too far off from the global financial crisis low. Next slide. And on a dividend yield perspective, it offers a dividend yield of above 4%, which is the highest in the entire region. Next slide. In terms of investor positioning, investors are largely underweight in the Sing market. We have seen 3 consecutive years of insti investor outflow, and that amounted to close to 7 billion in 2020. Next slide. So lastly, in terms of the stock recommendations, given our 2 key themes around recovery and restructuring, our top picks will be based on these 2 thematics. For recovery, we'll own a bank like UOB, as well as the transport names SETS for global travel and ComfortDelGro for domestic mobility. For restructuring, what we like is C for its exposure to ASEAN e-commerce, CityDev and Dairy Farm for the bottom-up drivers that these stocks could potentially present. So I'll end the part of the Singapore market here and hand over to Danny, who will discuss the outlook for the Malaysian market.
Hi, thanks, Gerald. Let me just take you through some slides on the Malaysian market. Firstly, just to start off by talking about earnings momentum, we have seen pretty sharp cuts in earnings in 2020. We did see something like 35% cut in net profit numbers for 2020. For 2021, we did see something like 14% cut in net profit numbers. But what is interesting to highlight is that in the 4th quarter of last year, we did see some of those cuts actually start to taper off. So we did see that, in terms of 2021 numbers, the market has started to revise up those numbers. And if you can look at the next slide, one of the reasons for that is that 3rd quarter results were pretty good. A lot better than what we saw in the 2nd quarter. The number of stocks that miss earnings expectations halved quarter on quarter to about 29% of our coverage versus 58% in the previous quarter. And on the next slide, just to give you a snapshot of what we're looking at in terms of earnings recovery in 2021, we are pretty much looking at a V-shaped recovery. Malaysia is expected to deliver the strongest earnings growth in 2021, largely because we're also coming from a low base as well. And I'd like to highlight that 2/3 of that growth is actually expected to come from banks, gaming, and gloves. And half of that forecasted growth is very much linked to the economy. So the GDP numbers and ability to achieve that will be absolutely key in achieving half of that growth, and the rest of it is not as well linked to the economy. On the next slide, if we look at ROE, the market is expected to hit an all-time low ROE of 6.1% in 2020 and rebound to 9.3% in 2021. And if we were to look at aggregate net profit numbers, we are only forecasting for net profit numbers to recover to pre-COVID levels in 2022 if we were to take out the gloves contribution to profits in 2021. On the next slide, just to have a look at the comparison of GDP numbers across the region, Malaysia is expected to deliver the third highest GDP growth in 2021. The government is forecasting 6.5% to 7.5% growth for GDP. And on the next slide, just to show you some of the key drivers of GDP growth, private consumption is expected to be a key driver. That's expected to grow by about 7% in 2021. That accounts for about 58% of overall GDP. Private investment is also expected to be a key driver. That's expected to grow by about 17% in 2021. And also, last but not least, infrastructure spending is forecasted to hit a record level of 69 billion, up about 38% year on year, and also expected to be one of the key contributors to GDP growth. On the next slide, just to talk you through some of the charts that show private consumption trends. Basically, private consumption is very much linked to unemployment rate. The government is forecasting a drop in unemployment rate from 4.7% right now to about 3.5% by the end of next year, with 500,000 jobs being created through the execution of Budget 2021. And that's something that will help to bring the unemployment rate down and drive private consumption. And on the next slide, if we were to look at private investments, this has also collapsed in 2020. Also, if we look at FDIs, that also has absolutely collapsed with the usual suspects of US, China, and Japan not really investing in 2020. And we do expect that to come back in 2021. And also, from a domestic direct investment standpoint, there's a lot of balance sheet capacity among the local investors. Largely, we would expect those investments to come in the tech space, in the property space, as well as the commodity space. And then on the next slide, just to show you the a chart on development expenditure, it is expected to hit a high of 69 billion. The key subsectors that will see a sharp increase in spending would be healthcare, education, and transport, all expecting to see between 47 to 64% growth in spending year on year. And then moving on to the next slide, just to show you a picture of what the COVID-19 levels are like. Malaysia really hasn't flattened the curve since a spike in the number of virus cases after the Sabah election in October. We are still struggling to bring those numbers down, and that definitely is one of the key risks that the market is faced with, because extensive lockdowns are not something that is factored into the GDP growth forecast for 2021. Moving on to the next slide, just to show you, I mean, this picture will look very similar across many markets. Foreign investors have been taking money out of Malaysia. We did see record levels of foreign outflows in 2020 of about 24 billion. I think the previous high before that was about 19 billion in 2015. Cumulatively, we've seen something like 30 billion leave the Malaysian market since the global financial crisis. So that has also dragged down valuations as well, which is something that I'll touch on in a later slide. On the next slide, just to show you that, one of the things that has been surprising in 2020 is an increase in retail participation. So this has helped to cushion the selling pressure coming from the foreign investor outflows. We did see something like 14 billion of net purchases by retail investors, which is a record level. When you compare with the last 2 years, averaging about 3 to 4 billion, the 14 billion in 2020 is a big jump. And then that has helped to absorb about 60% of the foreign outflows in 2020. So the key question is whether that is going to be sustainable in 2021, which is one of the risks that the market is faced with. On the next slide, just looking at the performance of the market, I guess if you look, at a glance, you'll see that Malaysia has done pretty well. But if you actually take out the gloves from the performance of the Malaysian market has seen about a 2% drop last year, which is more in line with what we've seen in the rest of the ASEAN region. On the next slide, if we were to look at valuation on the next slide, you'll see that the market is trading at about 13 times PE multiple right now versus a historic average of about 14 times. So that's a slight discount. Relative to ASEAN, Malaysia is trading at a 9% discount versus a historic average premium of about 4%. So that there has been a derating in the Malaysian market, and the record level of foreign outflows would be a contributing factor to that. So the market is looking cheap relative to its history, which is rare to say for Malaysia. And then turning on to the next slide, just to give you a snapshot of how the valuations stack up across the various sectors, you'll see that property, gaming, utilities, and gloves are among the sectors that are trading towards the bottom of the historical valuation range. And then just closing off, if you look at the KLCI target, we are forecasting 1795 for 2021. That pegs the market on a PE multiple of about 16 times, which is in line with the historic average. And then on the next slide, just to round off with a discussion of some of the stocks that we like in Malaysia. Given the uncertainty around politics around COVID-19, we do strike a balance between recovery and defensive plays. Among the recovery plays, we like banks such as RHB and CIMB. We also like the gaming sector for a recovery. And within that, we like Genting Malaysia. Construction for the fiscal stimulus. So within that, we like names like Ikonpal Gamuda. Property offers good value, and we're starting to see that there's some semblance of recovery in terms of demand. Sime Property will be the name that we like there. We also like Conglos for a consumer play like Sime Darby. And then for the sectors that are less dependent on economic recovery as a little bit of a hedge, we like gloves, which is currently trading at mid-single-digit PE multiple, offering very high dividend yield of more than 10%. We also like IHH for healthcare exposure, and tech. Within tech space, we like Inari. So I'll just stop there and hand it over to Andri to talk about Indonesia.
Thank you, Danny. A very good afternoon and a happy new year to participants. My name is Andri Ngaserin, Head of Research for Credit Suisse Indonesia. Just to show you our thesis on slide 54. We are actually optimistic on Indonesia. We do see triple levels for equity performance. Lever number one is that the Great Reset in 2020 has brought upon economic capacity back towards 5, 6, 7 years ago, whereby CAD, LDR are less of a concern, and while foreign and equity ownership are also at multi-year low. The second lever that we saw is that Indonesia now has an opportunity to break out of the current account deficit trap that's been lingering over the last 8 years. Omnibus law, it's one of the testament of a government wanting to invite further investments. And we do think as soon as this year, when the positive investment list is approved, it will finally see an early sign of FDI increase. The third lever that we are seeing is that there are continued low rates. In fact, our term deposit rates, time deposit rates are actually going down to about a low 3% now from the start of 2020, where it was about 4 to 6%. Concurrently, retail participation has also increased, similar to Malaysia experience. And we do think, given that rates are expected to be lower for longer, this trend will continue to increase. So if we move on to the next slide, just to show you what does this mean to 2021, we do think that the Great Reset at the bottom gear there, it has allowed excess capacity from a current account perspective, as well as excess forex balance as we measure from our import covers. So either scenario can happen, or both at the same at more tapered pace. So either we have an appreciating rupiah and continued lower rates as the economy remains slow, but there is excess liquidity in the system, and there is more scope for regulators to either manage rupiah appreciation, or for rates to be lower. Or scenario two, whereby economy actually accelerate faster than expected, imports recovered as well, and therefore leading to EPS upgrade. Credit Suisse Indonesia is leaning towards the first scenario, whereby we are expecting lower rates and appreciating rupiah, while there is a gradual EPS recovery, but potentially limited upside to EPS for the case of 2021. But that matters less compared to the what we think is a possible structural change from 2021 to 2024. If we go to the next slide, just to show you some charts on what do we mean by the Great Reset. This type of reset has happened before, and in the past it was seen in 2014, 15, 16 when the economy was overheated, and we can see that from current account deficit hitting above 3%. So the natural course of action back then was there was a managed policy where rupiah depreciated, consumption slows down. But during this reset, what is interesting is that typically there is a natural expansion that has happened for Indonesia case in 2017 and 18, and to early part of 2019 as well. So similarly, in this 2020 Great Reset that we saw, at the bottom left, we have seen imports has yet to recover, signaling input raw materials for the domestic economy has yet to recover. However, our exports has recovered following regional trade growth. That leads to what we see forex reserve to monthly goods import ratio, which is the highest level ever, suggesting forex balance is quite comfortable. If we go to the next slide, again, just to show, sorry, next slide, please. Just to show that how EPS trajectory happened during this reset period. It was typically negative. We have seen it on 2015 EPS, and we are seeing it during the Great COVID Reset as well. I think the positive news is that what typically happens is this excess capacity just allows EPS growth recovery for the following few years, and we expect the same for the next 2 years. Next slide. Just some charts on what do we mean by excess capacity. Loan deposit ratio being tight has been a topic often discussed in 2018-19, which then lead to NIM issues and lending tightness, right? But our LDR has gone back 7 years back to 2013 levels at 87%. Foreign bond ownership has also gone back to multi-year lows, as well as equity ownership. Foreign equity ownership. So all of this forms a low base. So if we this great excess capacity that we saw forms our view there is a general natural capacity expansion that we expect will be realized in 2021. If we can go to slide 61, let me jump 3 slides. The second lever, if we can jump to slide 61. The second lever that we see is that this current account deficit trap background, which leads to a self-correction mechanism, or in other words, is that Indonesia is unable to pay for its growth given inadequate forex balance. But however, I think what has happened in the past 1 year is very encouraging. Evidence to that is that if you go to the next slide, just a reminder that where Indonesia iron and steel export was to the tune of only about less than 2 billion as early as 2016. In 2020, it is now at about more than 10 billion, or about more than 5 times increases. Iron and steel has also become the third largest exports in Indonesia as of third quarter 20. and in recent months, it is as large as number 2. How is this achieved? Investments, Indonesia becoming the cheapest steel producer through partnership with China corporation called Chingsan. But this is just serve as an evidence that that the country did it and expecting more investment to come. If you go to the next slide, this is often discussed, but at the bottom chart, especially on the green bars there, these are the value chain potentially for potential value-added nickel towards potential battery for electric vehicle. The government is encouraging a lot of investments obviously on the press. We have seen a couple of announcements from Korean players, and we do hope there might be more. The idea is for co-investment to develop this industry. But what does this mean if this is successful? Is that if Indonesia takes part in the whole battery value chain for the next 4 to 5 years, there we can see a structural increase in exports, therefore allowing us to break out of the current account deficit trap that we are seeing. If I were to jump straight away to page 65, just to talk about the third catalyst. On page 65, essentially what we are seeing here is that individual retail ownership of the total float of the equity market in late 2019 was at about 21%. This has since increased 28%, then resulting year-end 2020 to about 26% ownership by the individual retails. This shows a massive increase in retail participation. Quite often in the last 2 months, retail is the majority of trades in the Indonesia market. And if you look at the structure of the local equity ownership of funds and individuals, this is 1/10 of the overall Indonesia bank deposit base. Given that our rates are at a low 3% for the top banks, and in our view may hit towards lower levels, we do think that this trend of retail participation is likely to continue in the future. So if we just go to the next slide, which just shows broadly our index sensitivity, our formal 2021 year-end index target using a +1 EPS forward of 2022 is 6,600. But just to give a sense of range that where we are right now about 15 times, which might go to a +1 in our view. And if FDI traction actually increases, it may re-rate further. And I guess just to end it is just to show our formal assumptions on the next slide. I think key to highlight that is that we are expecting the rupiah versus the US dollars to appreciate at 13,200 following scenario 1 of excess forex capacity and gradual economic recovery. There is a lot of 1 year improvement that can be done in 2021, but beyond that, it's the possibility of getting out of the current account deficit trap. So with that, I will end the Indonesia portion of the presentation, and we'll hand over to Hazel, who will take you over the Philippines market strategy.
Thank you, Andri. Good afternoon, everyone. I'm Hazel Tanedo. I will now discuss the Philippine outlook for 2021. So if you look at this first slide, sorry, next slide, please. Yes. So recent vaccine developments and declining new infections are tailwinds to the reopening momentum. As the chart would show you there, total cases in the Philippines are now at 440,000. This was mid-December. Currently, it's now at 470,000. But active cases only total to 23,000, of which only 8% are actually asymptomatic. And severe cases are only at around 5%. So the latest numbers in December would show you that the number of additional cases, which is an important factor that we look at, has been reduced closer to 1,000 cases daily. Next slide. So this table basically shows you that on the vaccine roadmap, the president has ordered that the vaccine should be made available to all for free. The government has been working with the private sector to achieve this. And currently, the Philippines is in the process of diplomatic relations and engagements to have a guarantee of access to the vaccine. So if you look at that table there, we are actually already on the preparation stage. The government is now in the process of vaccine procurement, and the aim initially is to roll out by 2Q of 2021, with the worst case scenario is for the rollout to start at end 2021 or early 2020. So the vaccine roadmap there shows you that it's expected to continue until 2024 with the aim of vaccinating 60 to 75% of Filipinos. Next slide would show you that mobility trends are also improving. This is a very important factor when we take a look at the Philippines right now. While lockdown restrictions continue to ease on the ground, Manila has shifted to a less strict lockdown with the GCQ lasting until the end of January of 2021. And with a move to expand the age range from 15 to 65 for people allowed to leave their homes. The less stringent rules on mall operators, shopping center operations should enable these establishments to attract greater foot traffic and activity. This comes at an opportune time when sales usually pick up usually at the December, lasting until January of the year. So looking at what the government has been doing lately, the IATF, they've already authorized the Department of Trade and Industry to adjust the permissible operating capacities of businesses here in the Philippines. So far, we're looking at an improvement. A lot of the establishments are already operating at 50% capacity. And more importantly, if you look at public transportation, it's now operating at around 55% capacity. The IATF, they've also lifted the ban on non-essential travel for Filipinos. So this is also a vital, an important factor, given that a lot of people here in the Philippines, with the ban in non-essential travel, as well as the rail lines being closed for the longest time, took a toll on the economy. So next slide would show you the economic team they're very optimistic of a gradual recovery to grow from here on, as it highlights the importance of easing quarantine and mobility restrictions. The government's team has recently reduced its GDP estimates in 2020. They expect a deeper recession, factoring in the recent impact of the typhoons. And they're looking at an 8.5 to 9.5% year-on-year contraction for 2020, but they expect the economy to bounce by 7.1 to 8.1% year-on-year for 2021. So this would require the timely implementation of the government's recovery programs, which we discussed in the earlier slides. Next slide, the central bank, as discussed in our Philippine panel earlier today, has shown its willingness to support any shortfall in government potential economic recovery so far this year. In its latest policy meeting last November, the Monetary Board opted to cut its key policy rates by 25 bips, which was considered as a surprise, actually. This meant that the BSP's overnight reverse repo rate was reduced to around 2%, while the overnight deposit and lending rates were also cut to 1.5 to 2.5% respectively. So all of which are new historic lows for the Philippines. Note that it was the fifth time, actually last year, that the BSP cut the policy rates, and the governor, who we had as a guest earlier today, has been reinstating that it's prepared to exhaust policy tools to guide the economy back to a recovery in 2021. Next slide, the central bank, they remain very proactive in implementing follow-on monetary policy intervention to manage the spillover effects of the pandemic. The president himself, President Duterte, has been urging lawmakers to accelerate the passage of key economic stimulus packages. After the enactment of the Bayanihan 2 in September, it does appear that the legislators heeded to the appeal of the government, of the president, rather, as the Financial Institutions Strategic Transfer Bill, or the FIST bill, as we call it, the Corporate Recovery and Tax Incentives Reform Act, or the CREATE bill, have all been passed in the Senate, and they're now up for deliberations. So the 2021 national budget has also been set at 4.5 billion. And if you look at the next slide, yes, so we think that the risk of a recession has already been priced in. We are on the path to economic recovery, and we are turning more constructive on Philippine equities, with 2021 year-end a target of 7,400. This optimism in light of foreign investor positioning amid year-to-date 2.5 billion net outflows, in our view, will drive positive market share price action. Valuations aside, we think that, when we talk when we look at the market, flows we think is a big factor as well, as with the other countries discussed earlier. So far, we've seen a huge outflow of around 2.5 billion, and we think that the recurrence of this the inflow of foreign investors could come into play and allow the market to overshoot our base case index target and reach our bull case scenario of 7,900. So main catalysts would include increased mobility as a result of vaccine hopes nearing better than expected inflation numbers and the faster decline in borrowing rates. At least if you look at the earnings profiles of the different sectors under our coverage, we're expecting the banks to grow by 10%, conglomerates to grow the fastest, one of the fastest at 45%, consumer to rebound to a growth of 63%, and property at 32%. Next slide would show you our index target for end 2021 is at 7,400, which puts valuations at 19.5 times 2021 EPS estimates. Our bull case of 7,900 would be driven by a sharp deceleration or decline of COVID-19 cases and an earlier than expected rollout of the vaccine. This would promote an earlier lifting, as I've mentioned earlier, of the restrictions in the lockdown and thereby drive consumption and business confidence. Our bear case scenario is at 6,700. That would be caused by further increase in new cases and a delay in the vaccine rollout. Risks for the market include a sharp increase in new infections, the underwhelming transmission of fiscal stimuli, a steep inflation uptrend amid rebound in oil prices, and the delay in vaccine deployment, which is something that we're watching out for. Next slide. We highlight key trends that exist as part of the new normal. We've been seeing it anecdotally around here in the Philippines. Retail omnichannel presence, increased use of financial technology, shift of consumers from wireless to fixed broadband, rise of domestic travel, and of course, spending for home improvement. Please move to the next slide if you can. Yeah, so some names that have actively invested in e-commerce and fintech capabilities are early movers in this trend are RHI, SM, and Home. Some names that have actively invested in e-commerce and fintech capabilities are BPI and Securities Bank. And with the hastened adoption of fixed broadband here in the Philippines, we expect residential penetration to reach sub 40% by the start of 2021. And beneficiaries of this trend include the telcos, PLDT, and Globe. And for the home improvement trend, we highlight key beneficiaries that are Wilcon and All Home. For domestic traveling, we like Bloomberry, which relies heavily on local mass market for gaming revenues. So next slide shows you basically our investment thesis. We favor increasing exposure in high quality cyclicals and mobility plays with solid earnings recovery story or attractive valuations. We view RLC as a compelling reopening play. And LTG and Home stand to benefit from an upturn on consumer discretionary spending. So on the other hand, the stocks that we want to avoid are mega-wide AAV. These are names to avoid due to lofty valuations and delayed recovery. So last slide, we are positive on banks and consumer and retail discretionary. Just to summarize the key points that we've made in the earlier slides, which include some of the consumer-driven conglomerates as well, and stay market weight on other sectors. So I'll pass on the floor to Farhan for Vietnam.
Hi. Thanks, Hazel. Good afternoon, everyone. I'm Farhan Rizvi, and I will go through Vietnam. Next slide. Can you move to the next slide? Yeah. So for Vietnam, unlike the other major ASEAN peers, Vietnam fared much better in 2020 with positive real GDP growth of 2.9%, which was still the lowest in about 4 decades. And this was supported by better handling of the COVID, as well as a strong public investment from the government. We expect the growth to rebound in 2021, supported by recovery in consumption, which slumped to 1.1% in 2020 to about 6.5%. and also an acceleration in FDI. Early signs of the recovery are already evident, and the 4Q Vietnam GDP data was very positive with about 4.5% GDP growth. And we've also seen consumption indicators such as retail sales accelerating to about 9.5% in December. That's the highest since January. And we've also seen consecutive strong industrial production numbers, which highlight that the recovery is very much on track, and supported by continued reopenings. And next year we should see this momentum continuing. I think on the FDI, while 2020 FDI was relatively resilient, if you look at the top right slide, we expect this an acceleration in 2021, given supported by the broader global recovery. We have already seen strong anecdotal evidence of Vietnam benefiting from the manufacturing shift from China, and particularly on the tech supply side, we have seen majors, Apple supply majors in particular, highlighting increased investment, and we should see that continue to play out and structurally next year and into the longer term. If you look at Vietnam's external account, it was very strong. We had a record high trade surplus in 2020, and this is the bottom left slide. And while we do expect that the trade surplus would ease off next year, we expect the external situation to remain robust, and that would also be supported by an acceleration in the FDI into next year. Like most of the other ASEAN economies, Vietnamese government has been unable to support significantly on the fiscal side, and we have seen the central bank doing the heavy lifting with significant monetary easing last year. And given that inflation remains relatively low, there remains room for a more accommodative monetary policy in 2021 as well, if need be. Next slide. Yeah, this slide, just want to talk a little bit on politics. While Vietnam's politics is relatively stable in general, this year is important because we are heading into the Communist Party Congress at the end of this month, which will select the leadership for the next 5 years. All 4 key positions in Vietnam's top political leadership will see changes, which will be announced somewhere around April. And the one thing that why politics will be important, particularly this time around, is the backdrop of the anti-corruption drive, which was driven very strongly by the current Secretary General. And all eyes will be in terms of how the leadership changes will evolve and what happens on that front. While we don't expect any material changes in the near term on the anti-corruption drive, I think the best case scenario for the market would be if Prime Minister Phuoc becomes the General Secretary. That is the strongest position in the overall political environment of Vietnam, and he has a very strong track record and is viewed very positively by the business community as well, which could mean a more medium-term improvement in the anti-corruption situation. Next slide. Now, in terms of the market, again, compared to most ASEAN peers, Vietnam did fairly well in 2020. The market was up about 15% in dollar terms. And in the last 1 month, you also seen the market rallying 11%, supported by the strong GDP numbers and the recovery on track. Despite that performance, valuations remain attractive. They're still trading close to historical average, and with corporate profitability turning the corner next year, we see about 32% EPS growth after a 12% estimated decline in 2020. We should see the momentum continuing. If you compare Vietnam, and if you look at the bottom left chart, the CAGR for Vietnam in terms of 2020 to 2022 is the highest within the ASEAN region at about 19%. So we would see even high mid-teens growth in 2022 as well. The sectors which will be driving growth next year in 2021 are consumer, financials, and energy. Liquidity also in the market has been at a record high last year and supported by very strong retail flows. And we should see this trend continuing given the recovery playing out. Now, can we move to the next slide? Yeah, so how, in this backdrop, how do you play on this recovery? So we would like to be positioned on the recovery theme, particularly in sectors that benefit, in particular consumer retail, financials, and property. So our top picks are across those space. So for consumer retail, we like Funan Jewelry and Mobile World. In banks, our top pick is VP Bank, while we like Winhomes as the best property play. While linked to that on the construction side, one can also look at Haufat Group. So those five are our top picks in the market. The key risk to our thesis would be a more hostile trade policy with the US. We've seen that. If there is more intensification of the anti-corruption drive, and issues in terms of the global economic slowdown. So those would probably be the key risks for the market. So that concludes Vietnam. I can hand over back to Danny for the Q&A.
Hi, thanks for that, Farhan. I think we've almost run out of time, so we may not have time for Q&A. But do feel free to reach out to each of us if you have questions for our respective countries or for a top-down view on ASEAN. Please feel free to reach out to Dan. But thank you very much for all your participation. And of course, before we go, II season is kicking off soon, so we would be very much appreciated, and I do speak on behalf of all the presenters here, we would very much appreciate your support if you feel like we have added value. Thank you very much, and all the best for the rest of the year.